Are you worried about any jitters and what that might mean for the S&P and broader benchmarks?
Brian, I don't think I'm a perma bull. I've been doing this for 40 years, and there are plenty of times when you want to hedge your portfolios or get out. But I don't think this is one of them. And I think you use weakness in some of these names if there is a sell-off, and there we'll get a correction, and that will be healthy for the market. And I think then you want to add to names that you either don't own or you don't think you own not enough of. You heard the Palantir. I mean, you just had a great interview on Palantir. That was an extraordinarily bullish report for the monetization of generative AI. So the naysayers have been fleeing the tech trade for the last 4 years that I can remember. It might be actually even longer. And every time technology comes back, and we've talked about how they're the new defensive names because they generate reliable earnings growth. And we've seen that again this earnings season.
What's been interesting is perhaps some of the companies that have outperformed that we finally get to understand where AI fits into their business model. And one that you haven't liked has been Mark Zuckerberg's Meta. Remind us of why and why perhaps, are you changing your tune since the mega rally come Friday?
No. We've owned it in the past, and we've made a lot of money on the stock, and we got out in the high 300s a couple of years back. I've been wrong on that, but there are other places where we've put our clients' money, and those have been maybe not quite as good, or in some cases better. But I just don't like the two-share structure. I don't like the business model. And I've been wrong. So it's an advertising company for sure. They are going to adapt and adopt AI, and that will probably continue to drive margins. But there's better places in our view. So that's where we've been hiding out.
Okay, so what would Meta and Zuckerberg have to do to change your mind?
Well, I think for now we've missed it, Ed, and so I love the dividend, and whether or not it was self-serving, I think he keeps about $700 million a year from the dividend. I love the notion of it, and I think Google should be paying attention. Amazon, which is a free cash flow horse or tank, however you want to characterize it. But in terms of Meta, I think we've missed it. So it would have to come down from a valuation standpoint, and we would need to see continued monetization across their platforms. But listen, he's done a great job, and there's no disputing it.
Nancy, there are a few things as romantic and poetic as the Bloomberg Markets Wrap headline, which reads, "Wall Street on hold as traders await more Fed speak." The inspiration and energy in the market. But it reminds us, forget all of the AI stuff. We're still waiting on the Fed, right?
I think the market is beginning to not listen to the Fed. And the reason I say that, Ed, is if you go back and look at Chairman Powell's comments, historically, he has been adamant about, we're not even thinking about raising rates. We won't raise 75 basis points. We're going to stay higher for longer. And each time he made those statements, he reversed himself a short time later. So I think what the market is seeing is, we may or may not get a cut in March, but we will get cuts this year. I think that the market is willing to coexist, as we did in the 90s, and I've talked about that on your show, with higher interest rates because they're not debilitating. And we've seen that. I mean, for the large tech companies, higher interest rates have actually been augured well to their balance sheet. They've grown cash because of the higher interest they're receiving on cash. So I think that the market is saying, okay, productivity is improving. There is a tight labor market. And again, that's going to continue to benefit technology companies. The Fed matters less and less each day that goes by, in my view.